Hello, my name is Rachel Croft. Today I am going to take you behind the scenes of the Walt Disney Company. We are going to explore the business's financial statements of the various business units and how they shape the Disney brand. Lastly, we are going to analyze and understand where the risks and opportunities lie in Disney's future. Back in the late 1980s, as a young kid, I began to get to know the Walt Disney Company. The first film I ever saw in theaters was The Little Mermaid back in 1989. I loved it so much that I saw it 6 times in theaters. This left an impression on me, and I have loved Disney ever since. Over the last 93 years, Disney has brought magical characters and stories to life. This is the company's enduring strength, the ability to sell magic to millions of people through a variety of mediums. This billion-dollar company has grown and shifted since it started back in 1923 by Walt Disney. Since its humble origins as an animation studio, it has developed theme parks, films, TV shows, and has proven to be a tour de force within the entertainment and media industry. Over time, it grew and evolved into having 4 primary business units. These business units are media networks, parks and resorts, studio entertainment and consumer products, and interactive media. Here we have each business segment's operating income. Operating income is the gross profit minus operating expenses. As you can see here, the Media Networks division is the most profitable business unit at the Walt Disney Company, leading with $7.76 billion. That is 48.5% of the business. Disney's total operating income for the year of 2016 is just shy of $16 billion. This is impressive. However, let's look a little deeper to understand what defines each business unit and what might or might not make each of them profitable. First, we have Media Network, Disney's most profitable business unit. This segment includes over 100 different channels in 36 languages, as well as cable and broadcast television networks as ESPN and Freeform. The main revenue generated for this segment is advertising, affiliate fees, and licensing content to other services such as Netflix, Hulu, and Amazon. This segment really defines Disney's business as a media company, largely basing their revenue off of advertising. Now let's look at their operating results. It looks like Media Networks has been highly profitable this year by bringing in $7.7 billion of operating income. However, when observing their growth, the operating income has hardly changed, if at all. This could be for a number of factors, but it looks like the most significant impact on growth is from equity income of investees. Equity in the income of investees is used to account for an organization's investment in another entity. This method is only used when the investor has significant influence over the investee. This 27% loss from 2015 to 2016 in equity is tied to losses in Hulu and A&E. This could be indicating that Disney has a significant stake in A&E and Hulu. The income for this business unit is affected by Hulu's and A&E's performance. Having equity in other businesses is a familiar strategy to Disney, for it helps them to diversify and also influence over other entertainment and media channels. This 27% loss from 2015 to 2016 in equity is tied to losses in Hulu and A&E. This could be indicating that Disney has a significant stake in A&E and Hulu. The income from this business unit is affected by Hulu and A&E's performance. Having equity in other businesses is a familiar strategy to Disney, for it helps them to diversify and also have influence over other entertainment and media channels. Next we have is Parks and Resorts segment, bringing in a total of $3.2 billion in 2016. This includes both domestic and international parks and resorts. The revenue generated for this segment is from the sale of admissions to theme parks, food, beverage, merchandise, nights at hotels, cruises, vacation packages, and much more. All these items are the majority of Disney's inventory. Let's look at how this business unit has been doing over this past year. It looks like it has been a profitable year for Parks and Resorts. The operating income grew 9% from 2015 to 2016. It looks like the cause of growth was driven by the opening of Shanghai Disney Resort. On the flip side, the opening of the Shanghai Disney Resort brought on overall increase in operating labor, as well as selling, general, administrative, and other costs have increased by 1.5% from 2015 to 2016. This is due to higher marketing spend for Shanghai Disney. Next we have is the Studio Entertainment segment, which produces and acquires live-action animated motion pictures, video to direct-to-video content, musical recordings, live stage plays, licensing of intellectual property for live entertainment, and much more. 2016 was a great year for the Studio Entertainment. The operating income grew by 37%, as well as revenue increased by 58%. This can be attributed to the success of Star Wars Force Awakens, one of the many successful IP purchases Disney has made in the last number of years. For one of Disney's successful business strategies is not only creating original content, but also purchasing IP rights to collect more stories and characters to develop and market further. Even though Star Wars was a major growth driver for the business, it was also very costly due to higher distribution costs, as well as selling, general, and administrative costs increased by $418 million, which is an overall 19% increase. This seems to be a significant contributing factor to the 31% increase in operating expenses. This notion of having high operating costs having a significant impact in the operating income is a similar story to what happened with Shanghai Disney Resort. Lastly, we have Consumer Products and Interactive Media, which generated $1.97 billion this past year. They primarily generate revenue through sales of games, licensing characters and content from film, television, and other properties to third parties for use of consumer merchandise. They also do published materials, selling merchandise in-store and online, and much more. From 2015 to 2016, it looks like they had a 3% decline in sales. This was primarily due to the discontinuation of the Infinity business. But regardless of losing revenue, the business still grew 4% over the last year due to higher results in merchandise licensing, as well as the decrease in operating expenses. These operating expenses are largely from the Infinity business, which was discontinued in early 2016. From understanding a little bit about each business segment, it is a clear theme in how operating expenses drastically affect Disney's bottom line. With all the business units combined, Disney has a strong media entertainment platform which provides a multitude of experiences for people to interact with their content. From understanding each segment, it is interesting to observe how Disney makes heavy investments and bets within each segment. It appears that their dominant strategy is about diversification. In general, the media entertainment industry requires a lot of cash to produce content and infrastructure for each major communication channel. This then potentially sets the business up for big booms and busts, for it is always uncertain how consumer trends and behaviors affect Disney's large investments and placement in the market. Next, let's step back and look at Disney's consolidated balance sheets and income statements. Regardless of their heavy investments in various projects, Disney still appears to be a cash-rich company with a total of over $4.6 billion. It has grown a modest 8% since 2015. Another interesting point to note on the balance sheet is the treasury stock. It is over 54 million negative shares. The treasury stock is when a company decides to buy back its own shares. There are a number of reasons why Disney might have done this. It could be so they can reissue them at a later date, or they believe their stock is so valuable that it should be retained or kept in the company's treasury to be used to create extra cash if it is needed. Next, I want to better understand Disney's liquidity. Disney's current ratio is 1-to-1. This shows that they have little working capital. Working capital is the difference between current assets and current liabilities. This means that Disney has either few assets that can be turned into cash or liabilities that are due in less than 12 months. This creates risk for Disney. As discussed earlier, Disney heavily relies on customers interacting with their brand, as well as ad sales. Disney is low compared to the media entertainment industry on average. Disney's quick ratio, on the other hand, is roughly at industry average. However, it would only have 92 cents of liquid assets available to cover for each dollar of current liabilities. The higher the quick ratio, the better the company's liquidity position. This gives more evidence that Disney might not be a good long-term investment, for this ratio seems to signify that they could have trouble paying off their liabilities. The current and quick ratio gave me some strong signals that I should be looking at Disney's leverage ratios. As suspected, Disney appears to be a highly leveraged company. 53% of Disney's assets are being financed by debt in 2016. This has grown steadily over the past few years. This sounds like a high number, however, this is atypical for this industry. Comparatively to Disney's competitors, other media entertainment giants such as Time Warner, Fox, and Comcast are in a similar situation. Disney's debt-to-equity ratio is 1.13 times for 2016. It looks like Disney has been consistently above the industry average over the past 3 years. This does not look promising to shareholders. If Disney were to go bankrupt tomorrow, creditors would be satisfied before owners. However, like discussed earlier, Disney has heavy operation costs. We can assume that a lot of debt is used to finance those operations, so the company could potentially generate more earnings than it would have without outside financing. This presents risk to shareholders. However, as a shareholder, if you believe that Disney brand will rise above and continue to generate success in the market, then you might be less concerned. Overall, it is safe to say that Disney is a highly leveraged company. Next, we are going to talk about Disney's income statement. It looks like Disney has grown only 14% in revenue over the past 3 years. This shows from a revenue perspective to be a steady company that can generate a lot of revenue. As well, it looks like Disney's total costs and expenses have gone up 10.7% over the last 3 years. This is in line with what we saw earlier in the individual business segments. Let's dig further into their total costs and revenue. We know, looking at liquidity ratios, that Disney is a highly leveraged company, but despite that, I want to contrast that with profitability ratios to best understand how the company is able to translate sales into profits. Disney in both these cases are a departure from media and broadcasting industry averages. Disney is only at 46% gross profit margin for 2016. Their financial health in relation to the industry does not look good. From what I observed earlier in reviewing each business unit, Disney struggles to keep down its costs of goods sold and operating expenses. To be able to improve this number, Disney needs to look for other ways to cut their costs. By contrast, net profit margin is higher than the industry average. This could mean that Disney's other expenses aren't as significant as other costs. Even though their net profit margin has shown little growth over the last few years, they have been able to keep their earnings consistent. Next, we have Disney's operating income. This I found quite interesting when comparing the industry standard, for it's significantly lower. This might be reflecting Disney's ability to manage training, administration, research, or other day-to-day business costs. But overall, this is not a good sign for shareholders. For a healthy operating margin would show that it is able to satisfy creditors and create value for shareholders by generating operating cash flow. Operating profit remains pretty consistent despite having an increase in gross profit margin. However, when comparing operating income ratio to industry's competitors, Disney actually came out on top with roughly 25% operating margin for 2016. This again might be tied to all four of these companies being highly leveraged with high costs to produce their products and services. One last observation in the income statement is that there is no R&D budget to be found for over the past 3 years. This leads me to ask, what is Disney's future? It seems that Disney's way of innovation is through acquisition and investment of other companies. For example, the investments in Hulu and the recent acquisition of BAMTech, a leading streaming technology platform. Those are their levers of growth. As well, its core, Disney is about bringing characters and stories to young audiences through a multitude of channels. They do not present themselves as a company who wants to redefine the movie experience or make new technology, but instead be where the audiences are to tell the stories they know best. It then behooves Disney to keep investing and protecting their IP if their primary strategy is to continue to build franchises around stories and characters that are already existing. However, regardless of the brand being deeply entrenched in American culture, Disney should be experimenting with furthering their business models, as well looking for more partnerships with technology companies and making sure they retain good talent. For the world of subscription services is slowly starting to dominate the television and film space, which does not include generating revenue through ads. Lastly, I will leave you with this famous quote from Walt Disney, who said, "We don't make movies to make money. We make money to make more movies." Thank you.